In this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's the Friday edition of Bonds versus Equities. I'm Mark Todd from FIIG Securities. If you have any questions, please pick up the phone and call us and talk about the share or bond market. Maybe not tonight. We're 1300 30 34 35. The email yourmoneyskynews.com.au. Joining me on the panel tonight is Craig Banning from NAV Wealth and James Todd, absolutely no relation. He'll want to be a relation at the end of this. He's the Managing Director of Wolseley Private Equity. Gentlemen, welcome. How are you?
G'day, Mark. How are you?
Number
Mark,
two for you. So you're a seasoned professional, and it's the first time you're on, so that's great to have you on.
Thanks, Mark.
Clearly, this show is bonds versus equities, and you do neither. So that's going to be good. It's going to be interesting for all the viewers. Let's talk about your business, NAV Wealth. Tell me a little bit about NAV Wealth, or remind the viewers about NAV Wealth.
Sure. We're a wealth management accounting business. So we deal with mums and dads that are interested in planning for their future and getting themselves in order, basically.
Yep. And how's business been? Picking up?
Yeah, really good. I think what's happened in the last couple of months, Mark, since I last saw you, was that I think with equity markets being good over the last 12 months, with a bit of confidence coming back into the society, I think people are feeling a lot better about themselves at the moment.
Really?
Property markets are picking up at the bottom end. So I think clients are now wanting to talk again. They're wanting to make sure their strategies are right and make sure that they're doing what they should be doing.
When you talk about the bottom end, what do you mean? Where's that range in your mind?
Yeah, what I'm sort of seeing through our client base, again, if you think of any suburb in Sydney, I guess, where we are, we're seeing three sort of levels. We're seeing the bottom end, the middle tier and the top end. The bottom section is on fire. So if you're selling a home unit for $800,000 at the moment, they'll be lined up tomorrow on auction day like you wouldn't believe. If you're at the top end of any suburb, that's still a bit under stress. So we're getting a lot of clients coming in and saying, wow, my equities have gone good. Should I stay there? Should I buy a home unit? Should I go into bonds now? What should I do? So
you always say yes to the last bit. James, how are things for you?
Yeah, good, thanks, Mark.
So you've been busy in the press of late. So do you want to talk us through what Wolseley Private Equity are and how things have been going with that?
Yeah, sure. Wolseley Private Equity is an independent private equity manager. We manage about $350 million on behalf of large institutions, most of whom sit in Australia, so I think the large superannuation funds and other financial institutions. We invest into established private companies that earn between about $5 and $20 million pre-tax, and we back the management teams to help grow those businesses over a 2 to 5 year horizon.
Is it hard to get access to those sort of corporations? Like how do you go about getting into those sorts of businesses?
Well,
who might want to sell? I mean, clearly you can find it through, you can do searches and all that sort of stuff, but in terms of making yourself available to them and vice versa, what's the easiest manner?
So how do we find companies to invest in?
Who might want to sell, Yeah,
well, if we have a think about the Australian marketplace, there's over 11,000 companies, private companies in Australia that generate revenue more than $10 million. So it's a large marketplace. If you break that down, about 70% of those are owned and run by baby boomers.
Right.
So that whole succession of management is an increasing theme in the marketplace. And, there's always companies looking to grow and develop, buy out competitors, need capital to, build a new facility or help grow. So, that's what we're in business to do, is to support the succession of ownership of private companies or to provide capital to help companies grow.
How does that play into the sort of business that you do? That succession planning, is that becoming part of a bigger part of your business? I'm very conscious of that baby boomer component to both the we talk about this in the fixed income piece. The baby boomers, as they move through their cycle, they look for consistency of earnings, and so that's why the bond markets tended to pick up of late. But in terms of the people coming to you, do they come to you with their businesses and say, look, here's the event, I'm looking to retire? Do you look after that side of it as well?
Yeah, we're trying to get clients to plan further in advance. So our problem is, Mark, if I look at what James does, our clients tend to be the smaller businesses, so they're getting to retirement and and wanting to sell their business for 1, 2, 3, 4 million. And the problem is they're all saying to me, Craig, I want to sell in 10 years. And I keep saying to them, but maybe a lot of people are going to sell in 10 years. With all this baby boomers coming through, we've got to get your business ready now. And I think that's what a lot of the smaller businesses, maybe the larger ones too, need to think about, is getting ready to sell.
Do you feel that they're prepared for the sale? When somebody comes to you and said, look, I wouldn't mind moving on, I'm at an age where I want to, do you think you need to then go to them early? I mean, when they go to you, go, listen, hang on a second, you've got to do a little bit of accounting here, you've got to get your affairs in order before we start looking at it? Do you give them that advice up front?
Well, we're there as an investor to invest on behalf of our funds to, buy business as well. We can accept that when we invest in a business, if it's not that well prepared for sale, we can come in and support the growth and development of that business such that we can improve the business that's there. But I always come back to the fundamentals. It's actually quite difficult to sell a business. There's a lot of settings that have got to be right. You've got to have a defendable business. You've got to have a management plan going forward. You've got to have a strategy to grow the business. So we don't often see that in a lot of the businesses that we see, and succession is a pretty challenging issue for a founder.
They're probably working hard on their own business. We have our first caller for the night. It's David from Canberra. How can we help you, David?
Hi, I just had a question on sort of bonds. I don't know much about them. I was wondering if you could sort of give a novice sort of an idea of what they are. Do they sort of sit between the cash and equities in the sort of risk-reward continuum, or if you could just give me an idea of what they do, sort of thing.
Sure. If you think of the capital structure, and we can talk about that in a second, but if you think about the capital structure of an organisation, the bonds sit at the safer part of the curve, and the way they think of that capital structure, it's senior debt, and we can talk about all different types of bonds. But if we talk about senior debt, we would think of senior debt as, in the event the company's wound up, the first people to get paid out will be those senior debt holders. And to create that senior debt, you tend to think of the company writing effectively an IOU with a consistent coupon payment over a period of time. For the senior bonds, let's say it's a defined period of time, it might be 10 years at 5%, and they'll pay you that on a semi-annual basis. And in the event that company gets into trouble, you're the first person to get paid out. That's the simplest version of bonds. The other simple version of bonds, which is even safer, will be a term deposit. And I think most people are familiar with the term deposit. That's a bond-like performance. When we think of the risk returns, we talk about Sydney Airport a lot here. At Sydney Airport, inflation-linked bonds give you about a 7% return if inflation's at 2.5%, and the equity's about 6.5%. So we say to customers, if you're going up the curve and therefore in a safer part of the organisational tree, and you can get the same return as the equity, it makes sense to go to the safer piece.
Yeah.
So that's our theme on the fixed income piece. Anyway, in terms of those organisations that, as you say, they're not ready to be set up, when you talk to them, is it a surprise to them? Do they say, hang on, I thought this was just a very easy sale because I really love my business? Is there a great education that needs to be taking place?
Sometimes. For a founder who's been in the business for 20, 30, 40 years, actually, deciding about the future ownership of the business, selling the business on, they want to be satisfied that the business is going to a good home, it's not going to be over leveraged, the employees are going to be looked after, the company will go on and prosper. And a lot of owners of businesses, they've spent their lives competing against their core competitors and are not necessarily that keen to sell out to a competitor who's in, and have their businesses integrated.
That would make some sense to, like if you wanted to sell out, sell a business and you've been competing for clients the whole time, it would be hard to then say, okay, you win, you're 10 years younger, you can have the business. Your customers that come and talk to you, is it the same sort of affair that they're not yet prepared, and that's the value add that you both offer to the client, that you say, look, I can tell you how to manage the business and therefore get it ready for a sale?
I think what saddens me at times, Mark, for the mums and dad businesses is that one of the greatest tax advantages in Australia is the fact that you can sell your small business and pay very little tax, or no tax in some cases, for significant amounts of money. But you've got to be prepared for that time. And too many people leave it too late. They walk into my office and say, Craig, I want to sell my business in 6 months or in 12 months. And I'm sure you
How much money are we talking about with significant? Have you got a number here? You're going to earn how much?
It could be a couple of $1 million tax-free.
Right. Tax-free dollars.
For selling a business if you're structured correctly.
I can assure
and if you meet the criteria.
I can assure you none of the Liberal Party will be watching this at the moment, so they won't be coming for you to get that tax. I'm sure they won't change some laws and legislations. What we want to talk about just now is that we will be going to a short break, but for those people who either ring in or send us an email, there'll be a guide to fixed income available for you if you provide a question that Jade deems to be appropriate, and we'll send those out to you through the week once we've got your email with your address. We'll have to go there. We'll leave it for a very quick break. We'll be straight back. Please call us on 1300 30 34 35 or the email yourmoney@skynews.com.au. Welcome back to the Bonds versus Equities edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities. Joining me tonight is Craig Banning from NAB Wealth and James Todd, who is the Managing Director of Wolseley Private Equity. They're here to answer any of your questions. They are planning people and private equity people, but feel free to pick up the phone. Call us on 1300 30 34 35. The email yourmoney@skynews.com.au. James, I just want to go back to you. We were talking about the fact you've been in the press. Let's talk about that business that you sold. It's the daycare business. So let's talk through the life cycle of that.
So we invested in Guardian Childcare 2.5 years ago. So we didn't buy it from an owner or a family. We bought it from a large property group. So, if you liked, it was a small piece of a large property group that was getting back to knitting in the GFC environment.
Yep.
It was a business that didn't really have a management team. It had oversight within the business. We did back an individual to support us to help buy out that business. At the time, we had 20 childcare centres and we managed 30 childcare centres on behalf of other people. The business employed about 700 people at that time and looked after about 3,000 or 4,000 families.
Right, so that's pretty big.
You know, so it's a substantial business. Our role was to actually pull the business out from a larger corporate, bring in and invest in a senior team to help grow the business. We bought 10 centres from 10 individual centres in the first year and a group of 10 centres in the second year of the ownership. Through that dedicated team and ownership, we were able to triple profitability through that 2.5 year horizon, continue to invest in the business. That business now supports 8,500 families, employs 1,700 people, and we've been able to deliver back to our investors some great returns. However, we're only a 2 to 5 year investor. Our job is to help grow and transform businesses, and we thought our job had been done.
Yep.
And we'd reached our prudential limits within our fund. So we invest, large financial institutions' money in pools or funds over dedicated periods. So we'd invested 15% of the fund into Guardian, and the right thing for the business was to go on and continue to grow and prosper in the broad Australian childcare sector. So it needed a new financial partner to help the business do that.
So you sell it to another organisation like similar to yourself?
Yeah, so we sold it to a Pan-Asian private equity firm. We'll continue to support the business. The management team are all shareholders in the business. They'll roll over their equity into the new structure. The new owner will provide capital to grow in Australia and maybe even put a foothold into Asia.
Sounds like a pretty good deal.
Yeah.
I think I am conscious of the fact that with large organisations, and let's say you're a mid-sized organisation, but different sized organisations, you can only deploy a certain amount of money on one specific asset. You can't double in and put all your money in it, because the people who lend you that money, or your investors, say, look, hang on, I need some constraint around how much money you can deploy to a specific asset.
Well, if we go back to the proposition, so we take to our investors an investment strategy and proposition that they support in those funds, and our promise to them is that we'll build a diversified portfolio across a range of maybe 8 to 10 investments per fund. Yep. So that fund is not beholden to one sector or one company, but is spread, diversifies across a range of sectors.
Is that something that you can invest in terms of the private equity? Is that an asset class, or how do you work out what investments you can make on behalf of your clients?
So this is a good question. So what we look at is a client comes to us and says, Craig, I'd love to invest in private equity. I've had a look at this, or a friend's told me about this, or whatever. Normally the issue we come across is that people want to do too much. They get all excited like we just did then when we heard James talk about his last deal, and they come in and they want to do 50% of their self-managed super fund into something. And so we spend a lot of time going, hang on a minute, let's get the percentage right for the risk you're prepared to take as a client, and also for your strategy going forward.
Do you think the clients have any idea about the risk they're prepared to take? Do you think or do they look at, I need 10%? Okay, well, hang on, you better give me a liver.
I think sometimes we can be the fun handbrake, as clients come in. We had a client the other day that came in and said, Craig, I want to take 600,000 out of my self-managed fund of 4 million and lend it to my friend. And when I started asking him questions about his friend's business, he said, look, I don't know anything about that, Craig, but he's a good friend.
Right.
And he would have done it if I hadn't had that conversation with him.
And you've talked him out of it?
Yeah, absolutely.
Because we can call him. We can take 400.
He might call in.
Yeah, he might call in. What about the returns? I mean, without wanting specifics, but in a general sense, if I'm an industry super fund, what am I hoping to achieve out of private equity? What sort of number?
So an industry fund will have a look at private equity as an alternate asset class, alongside of venture capital, alongside of infrastructure, and they'll be looking to at least achieve 5% more than they would in the listed equities market to cover off for the liquidity risk of not being able to sell their shares or their units in that trust day in, day out. So if we have a think about the Australian private equity landscape, if you have a look at the last 10 years and you marked private equity, the average returns out of private equity to the ASX 300, private equity's delivered on its goals of delivering more than 5% above those ASX 300 returns.
But hang on, is that a reflection on how badly the ASX 300 has gone, or is it more a reflection of how well you've done? And I, when I look at the performance of people like the FIIG and those guys who are great, and they say, well, I don't really care what the index is doing, I just have to make my clients money. My sense is the equity piece has not performed quite as well as as everyone would have thought.
Well, you'd probably know better about the ASX 300 and how it's performed through that 10-year cycle.
Disaster.
If you're a private equity manager, you don't really mark yourself to the ASX. You mark yourself by absolute returns. So if we want to continue to raise subsequent funds and attract great institutions into our pool of investors, we've got to be delivering, our benchmark
real
is,
money.
20% plus net returns back to the investors.
Yeah, right. And that makes sense because, I hate the index huggers because it says, it all went under and I didn't go under as bad as everyone else. You said, well, hang on a second, we're still going under. Are you finding it hard with your clients finding the right assets to buy in terms of the returns they want? Is there the effect of crowding out? Are people able to come look at term deposits as an example?
Well, I think the fixed interest, if I look at a client's portfolio, growth assets and then fixed income assets or defensive assets, I absolutely believe the defensive asset allocation is the hard part at the moment, which is why FIIG exists. And exactly right. We need the experts like your firm because the growth assets people understand, they know what they're buying, and so what a lot of clients I'm finding at the moment, they're saying, Craig, I know you say I've got to have bonds as part of my portfolio, but what if interest rates rise and how do we solve all these problems? And clients are even saying things like, should I have term deposits, take the lower rate of return and then increase the equity risk to compensate for the lower rate of return in term deposits? Right. And I'm going, look, it's not a case of sitting out of bonds altogether. That's not the case. Interest rates aren't going to boom in the next couple of years. No. Well, the policymakers have said we're going to keep interest rates low for the next 2 years at a minimum. So I would think that for those who are worried about interest rates going up, get a floating rate note, exactly. And something goes up with the interest rates. I don't know that interest rates are going to go up in the next couple of years just because everything seems so soft. The economies of the world, I know Mr. Abbott's going to solve all our problems, so we're fine, but the economies of the world seem soft in general, and they have lots of problems. Europe
they talk about the green shoots, Draghi was out last week. He said they're very, very small. Europe has got so many structural problems to try and address. So I think it's a challenge. Part of the idea to address it has been to print money. So we have got an email from Morley, our first email for the night, and he's written, "Hi there. Where has inflation gone? Lots of money printing should lead to inflation. Commentators are calling, but nothing's happened. So what's going on?" I think, in answer to that question, I think it's about the productivity gap. I think if you look at the United States, they had this thing called the jobless recovery. That just means there was no jobs. And though that employment piece is coming down, it's still in the high sevens, mid sevens, and it's the lack of productivity. There's this output requirement. So at the moment, there's not enough work. And so that's why that inflation piece hasn't kicked in. People are still accepting the US dollar for being a fairly good currency, which,
Yeah, well, if we look at the marketplace and you take the big four banks out and you take the resources sector out, it feels that it's been pretty tough for a long time.
It's been a completely joyless recovery. If you look at the stockbrokers, they're saying it's just anemic. There's no natural drivers. And I was reading Coppo's report. So Coppo's the guy from Goldman's. And he was saying we are close to the 2007 highs, and I really don't feel like there's champagne being popped by stockbrokers, by Myers, by all the retailers. You talk to the Harvey Normans of the world. All these businesses are really struggling, and forget tourism, forget education. All those businesses that rely on a low currency, that's a struggle.
Yeah, and I wonder if it's just a different, you put the government pulls these limits around monetary policy, drop interest rates, or everyone will start spending. But I wonder now if we're moving to a different phase. If you take these baby boomers, they're all moving into retirement, and prior to retirement, things were great. They were travelling, spending a lot of money, having a great time, earning a bit. The kids had left home. Now they're moving into retirement as well. They're spending less. They're watching their money more. So I think there's lots of other levers going on too in terms of spending and retail.
But you're saying that with these lower interest rates, we're seeing a real pop in the property market.
Yeah.
Whereas the RBA would be saying we haven't seen the consumer do anything. That's been the greatest problem.
Yeah, I think in spending, definitely that's the case.
Well, I think that's the marker, isn't it? If you look at interest rates, they're at all-time lows. So.
All-time lows and seem to be trending lower. I think they'll go to 2%. We can talk about interest rates after the break, but we'll go to another short break. Please feel free to give us a call, 1300 30 34 35 for any questions you have on investing, and the email yourmoney@skynews.com.au, and we'll be right back. Welcome back to Your Money, Your Call. If you'd like to speak with our expert panel, please pick up the phone and call us on 1300 30 34 35. The email, as you know, is yourmoney@skynews.com.au. Before we move in, mate, we've been talking about the private equity piece, and you have a colleague, Andrew Petering, who's written a book, In the Driver's Seat. So for the viewers who may be interested in one of these books, we're very happy to pass those over if you send us an email with your address. And it'd be great if you have a question on private equity, or any question would be good. And it's written by Andrew, and it's explaining the world of private equity in terms of good, bad, indifferent, and all the various terms. And it's basically an education tool in which to try and get a sense of the product.
Sure, that's exactly right, Mark. The two audience that were really geared into this book and into Andrew's thinking was to help explain how private equity could help private companies.
Yep.
How it could help in a succession solution, how it could help in a growth or a capital solution. But the other audience, and really the real content of the book, is Andrew interviewed 12 CEOs of private equity-backed businesses, not just Wolseley CEOs, although there's 2 or 3 within the book, just to explain also from an executive's point of view what it means to partner with private equity to run a business.
No negative stories, I take it. There might have been a few, leveraged by
obviously not the Wolseley ones.
Exactly.
But I think it's an honest account of, private equity is a very attractive medium for successful executives that are looking to have some autonomy in the next business that they might run, and have some equity in the game that can create real wealth over a period of time.
We've got another caller. The caller is Daryl from Melbourne. How can we help you, Daryl?
Hi, guys. I'm one of the baby boomers that's looking to retire in the next 5 years, and was just wondering what would be the minimum value or turnover of a business that an equity company would look to before perhaps getting involved in a buyout?
The minimum term for a private equity company to buy?
Yep.
Sure, I could take that on if you like, Mark.
Yep.
There's no minimum, if you like, but there's a range of private equity managers or companies in the marketplace. From a Wolseley perspective, we're looking to invest in companies that generate $5 to $20 million worth of pre-tax profits at the outset of our investment. And that's really geared around structuring the size of our investments across funds. However, there's larger private equity funds, some of whom you might read in the papers around the leverage buyouts of large transactions. That's not what Wolseley and most of the private equity community does. That's only a very small number of the companies. There's also some private equity managers who sit beneath Wolseley in terms of the deals that they look at. So they'd be looking at probably at least $1 to $2 million worth of pre-tax profits before they might invest. What I might suggest is all the industry managers sign up to the industry body, which is called AVCAL. So
AVCAL?
AVCAL, AVCAL. So if you go to avcal.com.au, there's the list of the 60 to 70 private equity and venture capital managers who address the marketplace and who have available capital to invest.
Darryl, I hope that answers your question. Seems a pretty good, comprehensive answer to me. And thank you for the question. Let's just move on to... I did want to talk to you about the QE and about the fact that there's a pressure on, do we taper, do we not taper, all that sort of stuff. How does volatility... All the other guests have come on to be mainly a trading type environment and trying to work out what to do with markets. But does volatility affect you guys at all in your business? If I can start with you.
Yeah.
In September, will they taper, will they not taper? Let's say they don't, volatile. Let's say they do, how much? It'll be volatile.
So a few months ago, we had a lot of clients coming in saying, Craig, what's this QE mean and how's it all work? And there was quite a lot of noise a few months ago. Now we're not getting any noise at all, but I think that's because the noise for us will be driven around volatility. I think as soon as clients start to see volatility, they then start saying, what's this mean and how does it affect me, Craig?
Right.
So I don't know if we've had any detailed discussions in the last few weeks.
What about yourself? In terms of 2 to 5 year investing, you shouldn't have any, but does volatility in markets mean that your investors get nervous?
Not really. We're investing for the medium term. So in some ways you have to be a little bit contrarian. How can we transform? How can we grow? How can we corporatise the businesses that we invest in? Where it does impact us is if the dollar moves from $1.05 to 90 cents, does that impact the underlying business? What are the equity markets doing when we're coming to buy a business or when we're coming to sell a business? I think that impacts around the edges, but the core thesis is to back good businesses with great management teams and grow them. How do we double, triple profitability over that 2 to 5 year horizon and sell better businesses, either to larger trade players, other financial players, or we've listed 1 or 2 of our businesses as well.
I mean, we're going to talk to you a little bit about finding those guys and about how you would tap into your natural infrastructure, but we have another phone call, and this is from Rustin from the Sunshine Coast on equities. How can we help you, Rustin?
What I wanted to know is, what is the best equity in a short term? I'm not looking for great returns, but as safe as possible.
It's very hard to provide advice until you can get a sense of the client's portfolio, but if you are looking to buy equity as possible, the context is you're buying at the riskiest part of the world. That is where it's at most risk. So equities are riskier than other assets. So if you're worried about your capital, you need to either buy term deposits or you need to buy senior debt on corporations like Telstra, Stockland, Westpac, that are much safer than taking an equity risk.
Yeah.
How would you answer that question?
Yeah, I think for me, it's so important that clients like our caller get advice that's based to them.
Yep.
When I look at our client base, every client gets different advice. There's no sort of sample, you should have this many BHP shares, you should have this many Coles Myer shares. It's all individual to the client's risk profile and needs and strategy. So for our caller, I think it's a case of where is he in his time frame? Is he retirement, close to retirement, a long way from retirement? What's his risk profile? What's his strategy? And then a good advisor is going to be able to say to our caller, this is the type of asset allocation, including bonds, that you should have.
But if somebody says to you, I don't want to lose any money, you can't buy equities.
Yeah, and I guess what we would do in that case is spend some time educating our client on what do they mean by that. Do they flat out mean I don't want to lose any money? And if that's the case, you're very restricted to term deposits and cash. And then we've got to have another conversation around, if you're going to do that for the next 20 years, will your funds keep up with inflation?
I mean, the equity market feels soft at the moment just because of all the, the uncertainty around September. So it's hard to be saying to clients, let's just go and have a bit of a crack at the equity market. Unless you're first-time investors, it would be challenging.
Yeah, now it is.
I would think. We have to go to another short break, but please feel free to give us a call on 1300 30 34 35 for any questions you have on investing, and the email at yourmoney@skynews.com.au, and we'll be right back. Welcome back to the show. If you have any questions about bond, equity, private equity, planning, whatever you like, give us a call, 1300 30 34 35. The email is yourmoney@skynews.com.au, and we'll be going to our second email, I hope, which is from Peter. And Peter's got an email here about what is a CIB, what is an IAB, and how are they different? All the best. So I think I can take the start of it. A CIB is a capital index bond. So if you put down $100, the $100 grows at the inflation. These are all inflation-linked bonds. So the $100 grows at inflation. At the maturity, it's whatever the compounding inflation is, the issuer owes you that money. And the IAB is an indexed annuity bond. And so what that is the cash flow. The money you're getting is indexed to inflation. And so if you think of one as having a great big pie at the end, the index annuity will have nothing at the end, but you'll have received higher cash flow through the life of the bond. And so what we find is at FIIG, what we find is a lot of clients put those two together, buy both.
Yeah.
So they have higher cash flows and then a big nest of money to go at the end, and then they recalibrate again. Do you do much in these?
Yeah, so I think what's good about this question is it brings to the table the fact that clients have to have a combination of defensive assets, don't they? And it comes back to what's the client after. Are they after a higher income or a lower income? Do they want capital in the return of their income payments or not? So I think for us what it's about is what's our client trying to achieve, and then putting together and constructing the portfolio and using companies like FIIG to work out that combination, which is a specialist field, I think, even beyond a lot of planners.
It's amazing how many issues there are in these assets. There's the Australian National University, AA- credit, and they issue these things out to 2030, and there's a whole range of them. And I think the key to it is similar to your business in that they're small issues. So it's very hard for big organisations to take a chunk. In the same way your business would say, I can only put 15% of my money into an asset. You can't buy an asset that's only worth $2 million because it's too small as well, and that's where these things, suit your customers. They're small issues. Preco has about $40 million issue, so it's perfect. Big funds can't buy it, and you get some great returns once you can find them. We have another caller, and the caller is John from Sydney. Hello, John. How can we help you?
Yes, thanks very much for taking my call. My call's more of a general question, and that is that I'm looking to transition to retirement in relation to work. I've got 2 investment properties already, and I've got a small portfolio of shares worth about $50,000. But what I'm looking for is a recommendation from you guys in terms of companies that offer a DRP, because I think to myself that I'm not too concerned about the income in terms of getting the dividends, but I'd rather just sort of build up on the shares themselves, and so when I do finally retire, I can just sort of basically cash them in.
Get some growth assets. When do you think you'll be retiring? How long till retirement?
Well, I want to transition hopefully next year, and probably retire probably within the next 6 to 7 years.
Right.
Maybe 8 at the maximum.
The man on my left is clearly the expert, because I'd have absolutely no idea, but I will pass it over to you, Craig. You can pass it on to me. That's a good question, because it's all about education. He's taking the advance 6 to 7 years, and so, John, great question, but Let's see if we have a great answer.
What I like about John's question is the fact there is 6 years to go.
Yeah.
So we would sit down with someone like yourself, John, and we would look at, okay, what are your current asset levels like now? What kind of lifestyle do you have now? What kind of lifestyle do you want to have in 6 or 7 years' time? And make sure that the construction of the assets in 6 to 7 years' time reflect the income that John wants to earn. Right. Because what often happens when people are in their growth accumulation phase, they're in their 50s and 40s, they have a lot of assets like properties and things that don't produce a lot of income because they don't need income. But when they get over into retirement, that's when they need income. And you want to make sure that you don't get to the day of retirement and having to sell everything. Because what if the markets are down in whatever assets you own?
So, though you don't have all of John's details, would you think that with what you're seeing in the property market, the absolute is going for it, that it might be better if he's got two to look at selling one and take advantage of the cash, or do you think that's too strategic?
So what we would do is we would say, let's look at the property portfolio that they've got. We would bring in one of our property external partners to provide advice to John about which properties are good to keep and which ones aren't in terms of the future. And then once we determine that, let's say one was to be sold, we'd then put together, construct a portfolio on what John should have so that over the next 6 years he'll be ready for retirement.
John, I hope that provides an appropriate answer for you, because it sounded pretty good to me. So there's two good answers. I'm the weak one. I've got to find a good answer. We will go to another short break. We'll be straight back. Feel free to enjoy. Welcome back to the Bonds versus Equities edition of Your Money, Your Call. We're still taking phone calls. The phone number is 1300 30 34 35. The email yourmoney@skynews.com.au. And a special hello to Kevin Hogan, the new member for, I think it's somewhere up north, I don't know, Yamba, but he's there in the lounge saying he's having a great old time, so that's good. Let's talk about bankable CEOs. What is a bankable CEO?
Well, a bankable CEO is a Wolseley terminology around a great chief executive with proven success at running a business who's looking to run a private equity program. And it really came out of the market. If we look at that market of 11,000 plus companies that are turning over more than 10 million, a lot of the businesses that we have a look at, either the owner-manager wants to retire or the manager wants to retire, so who's going to lead that business through the next phase of the company's ownership? So we love working with bankable CEOs who have proven experience at running a business, deep industry knowledge, and will invest time and resources behind quality executives to look for businesses that we can buy together and they can run with our support.
Do you cultivate these people while they're still in their jobs in other fields? So, I'm running XYZ organisation, Craig's running his business. You start building those relationships now when you think they're good CEOs and they'll be good in other another financial services business at some stage down the track. Is that something you cultivate now?
Sure. Yeah, I think we're always cultivating bankable CEOs, whether they're in a current job or whether they're looking for the next gig. So we'd run several events through the year. We've currently got about 50 bankable CEOs on our panel. We can't work with 50 CEOs at any one time, so we're currently working with one or two to find a business that we can buy together, and off we go. So I think it just provides optionality when we're looking at companies to invest, because a lot of the time we don't mind if a company's not beautifully set up for sale. That's okay. We can still get a transaction to come. If it needs a management solution, well, hey, maybe we can bring in a management team to
clearly that's what the value add's supposed to be for private equity, to bring in the management team. I was working in the States, and they're not watching that, thank God, but their private equity performance was just leverage. They buy an asset, stick a lot of debt with it, and then flog it. And it was just a financial play without any real management skills. What about yourself, mate? How does that work with you in terms of talking to clients who you would be... James is talking to people who might want to consider. Yeah. Are you talking to people that don't know that they should be considering? Is that a problem for you? How's that conversation?
Yeah, I think it is, because a lot of our small business owners, they run a great, successful business.
Yep.
And the kids have grown up and they're sitting back in their business, they're earning great profits, great cash flow. And the last thing they sort of want to think about is ending that.
Yeah.
And I think what they've got to realise too sometimes is that it might take 5 years to transition, and that may be in a smaller business. They even have to take pay cuts so that they can bring in a new potential partner who may buy them out 5 years down the track. And a lot of our clients will say, but Craig, if I bring in a partner, then I've got to take a pay cut to pay for that partner. And I'll say, but that might be an advantage if you can sell the business in 5 years and pick up a tax-free lump sum of money.
Yeah.
So the short-term pain might be worth it for the long-term gain.
Does it work? Is it that narrative that you're discussing, is it more successful than not, or do you find that most people just say, look, I can't see the inevitability, I can't see the fact that I'd have to move on?
You do have to work pretty hard at it. There's a lot of businesses that just close their doors. A lot of businesses, they just retire, close their doors, move on, and it really saddens me. You probably haven't seen it.
Yeah, well, I was just thinking, we picked up some university research on Australian private companies, and only 1 in 3 businesses transitions from generation 1 to generation 2, and only 1 in 6 transitions to generation 3. So that whole succession of family ownership is a big issue, and with the baby boomers into their 60s and beyond, it's becoming a more pervasive issue in a lot of the investment situations.
Do you think it's more a function of also the money, the very successful businesses, transition to the next generation, and that makes it slightly more successful, but then the next generation, the third generation, probably say, well, do I need to work? Do you think that's the part of did the analysis say that they're just rich fat cats that don't care?
Well, it's the classic 3 generations, isn't it? I think it's different for each family. There's a family-owned business. I think a lot of founder owners have special skills. It's not easy to start and build a business, and just because children are within that family doesn't mean to say they're going to be great managers of that business, and they might not have had the same hunger that the founder might have had. And
also, as you said, how many times do you hear the fact that somebody was an entrepreneur and then he had to get a person to run the business to come in there, completely different skill sets? And that must be very hard for an entrepreneur at the smaller level to accept. That there's a different skill set that you don't necessarily have, because you think once you've built it, you're good on everything, and you probably micromanage.
Yeah, sure. Harvard has done a famous study on that. It's the seven levels of management required to grow a business from start-up to successful, mature business, and not everyone's capable of performing at each level.
It's time for a very short break. We'll be right back in just a moment. So it's the last segment for the night, so we'll get straight into it. Leverage buyout versus capital growth, James. What's the difference?
Well, leverage buyouts are typified by large businesses with repeatable and sustainable performance, are owned and bought by financial sponsors, private equity firms, whether domestic or international private equity firms. And the real key to those transactions is a very high level of leverage as a part of the balance sheet. I think capital growth is more what we do, which is around looking to generate our returns through the improved performance and profitability of the business. So in the way that we look at leverage, we're looking to very prudently leverage, 1 to 2 times earnings, as opposed to some of these large leverage transactions that are 5, 6, 7 times.
So Channel 9 would have been a large leverage transaction?
Well, that was a very large investment done at the peak of the market. I think the business was bought for 11 times EBITDA, and they probably put 8 turns of debt in that business. So there was a huge debt load, and we hit GFC in a difficult economic environment, and that unravelled and had to find its way into different hands.
Yeah, and easy to judge, and it was different times, and it's just one of those things that you have to learn from that experience and say, it's like anything, you can't borrow too much money. Mate, tell me, what do you think, because we're in the last segment, low-hanging fruit, what's the investment advice you'd say to somebody, look at that one, I quite like that?
So one of the things we're talking a lot to our self-managed super fund trustee clients, mums and dads, about at the moment is the last 10 years, everyone's been very focused on Australian equities, Australian assets, which has been a good thing. But looking forward, we're starting to say to clients, we're going to have to start increasing your assets to investments overseas. So not in a huge big swing, but let's start to look at some countries overseas that have been undervalued where we can start to have some exposure in those assets, particularly if our currency keeps falling.
Yep, so the emerging markets in the United States, that sort of stuff.
UK, those types of places.
UK, oh yeah, okay. And Europe, clearly there's a farmhouse in France you could buy cheaply. What are your worries? What's the in terms of the economic sense? Is there anything on the horizon you say, look, I'm worried about, US politics? I mean, is there anything that stands out?
No, I think what worries me are things that I can have a control over. So, how's the business doing? We've got 9 companies within our portfolio at the moment, so they all move differently. Some are doing better than others, and there's always issues in any business. So they're the things I tend to focus on and worry about. I actually think it's quite an interesting time in the market sense. We've got interest rates at all-time lows, and the equity markets seem to be coming back into a bit of life after being down for 5 or 6 years. So I think it's a pretty good time to be buying businesses, a pretty good time to be doing things, and I think the level of economic activity should pick up over the next year or two or
9 businesses worth how much? How much is that? Is that all the money? Like it's $300 million that's been invested? How do you work that out?
So we've invested most of that $350 million across those 9 businesses.
Sell them now, and that's why you come back. That's what you'll be going on a roadshow to talk to your investors about getting more money because you've done quite well with the investments you've got.
Sure, that'll be in the near term. We'll be going back to do that. We're currently selling a couple of businesses. We're just buying a health business at the moment. So there's always that underlying transaction.
The health piece is an interesting thing to talk about, but we are running out of time. Just remember, James has got that book. It's in the driver's seat. For those who are interested, please send us an email. And the guide to fixed income. Yet again, if you'd be interested in that, please. Don't hesitate to send us an email. That's all we have time for tonight. I'd like to thank all the viewers, but also Craig Banning from NAB Wealth for coming in on a Friday, and James Todd, absolutely no relation, from Wolseley Private Equity. He's the Managing Director. To you, all the viewers and everyone watching, we've really enjoyed it tonight. I'm Mark Todd, FIIG Securities. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.